There is a country that imposed sanctions on Iran for years, that pushed Tehran toward confrontation, that watched the Strait of Hormuz close and the global oil market go into crisis. And that country is now exporting more oil than at any point in its history, selling into a market where prices are 50% higher than they were 3 months ago, to buyers who have no other option. That country is the United States. And this is the story of how Washington's crisis became Texas's boom. Let me give you the numbers first, because they're striking. Before the Strait of Hormuz closed on February 28th, the United States was exporting 3.9 million barrels of crude oil per day, already a historically high level. By April, that figure had reached 5.2 million barrels per day. May partial data puts it at 5.5. Both are records, according to the EIA. Brent crude is trading around $110 per barrel, up 50% since the war began. Every barrel the US sells into this market captures a premium that would have been unthinkable 6 months ago, and US production simultaneously sits near all-time highs. The Permian Basin keeps growing. Texas didn't start this war, but Texas is winning it. The pivot in Asian buying is the most dramatic thing in the flow data right now. Japan imported 12,000 barrels per day of US crude in January. By April, that figure was 535,000 barrels per day. That's a 45-fold increase in 4 months. South Korea went from 474 to 846,000 barrels per day, a 78% increase. Singapore, which functions as a major re-export and storage hub, not a final buyer, received 252,000 barrels per day in April, up from near zero. Combined, these 3 markets added over 1 million barrels per day of new demand for US crude in a single month. That's approximately equal to the entire crude export capacity of Libya, created from scratch in weeks. Japan's own trade data, published on May 21st, tells the same story from the import side. Japanese crude imports fell 64% by volume in April, the steepest decline since 1980. American crude offset part of the collapse, but not all of it. Japan is running on strategic reserves, buying American where it can, and still running short. Here is what makes the US position genuinely extraordinary. The United States is simultaneously the world's largest crude exporter, largest LNG exporter, and largest natural gas producer. That combination, held by no other country, means the US is the swing supplier on 2 separate energy crises at the same time. The same Texan production infrastructure that is filling European LNG terminals is also loading supertankers bound for Tokyo and Seoul. 2 crises, 1 beneficiary. The compound effect on US energy export revenues is significant. The Permian Basin, the Gulf Coast LNG terminals, the Treasury, all running at maximum benefit from a conflict that 90 days ago, Washington did not expect to last this long. But here is the part the market is not fully pricing. The US export surge is often described as a bridge, temporary supply, filling a gap until Hormuz reopens. That framing rests on an assumption the physical data does not support. Vessel tracking shows approximately 1,000 and 50,000 barrels per day of laden crude transiting the strait, roughly 6% of pre-war volume. The strait has not reopened, it is trickling, and the inventory consequences are accelerating. EIA data shows global stocks fell at 5.27 million barrels per day in March. That accelerated to 8.62 million barrels per day in April. Independent analysts, cited by Reuters, estimate the rate may reach 11.2 million barrels per day in June, a cumulative draw of approximately 1.2 billion barrels. At that pace, some commercial inventories could reach minimum operating levels as early as August. Reuters put it plainly on May 21st. The market likely has about 3 months before tightening supplies begin to bite in earnest. The US is not filling a gap that is closing. It is filling a gap that may stay open for months, against an inventory backdrop that is getting worse every week. One variable the market is implicitly relying on has not been deployed. China holds between 1.2 and 1.5 billion barrels in strategic and commercial reserves, the largest stockpile on Earth. If Beijing chose to draw that reserve at 1 million barrels per day, it could provide meaningful relief to the global system for years. But Reuters reported on May 21st, China was still building its stockpile in April. Its crude surplus was 430,000 barrels per day, even as imports fell. The market's largest potential buffer is not being deployed, which means the pressure on global supply is structurally more severe than headline figures suggest. Now for the part of the story that doesn't make the front page. The US energy export windfall is visible. It flows to Midland, Houston, Corpus Christi. It shows up in quarterly earnings. It's taxable. The costs are different. They're diffuse. They're building slowly. And most Americans have no idea the war has anything to do with them. Start with gasoline. The national average for regular grade stood at $2.90 per gallon before the war. By May 18th, it had reached $4.49, a 55% increase in under 3 months, according to EIA weekly data. The $4 threshold, historically the level at which energy costs become a primary electoral concern in the United States, was crossed in the first week of April. It has not been recovered since. But gasoline is the visible cost. The invisible one is naphtha. Middle East naphtha exports, the feedstock that feeds the global petrochemical industry, collapsed 73% after the Hormuz closure. The US stepped up and filled about 18% of that gap. Then an estimated 845,000 barrels per day of naphtha supply remains missing from the global market. Naphtha becomes polyethylene, polypropylene, polyvinyl chloride, plastics in packaging, automotive parts, construction materials, consumer goods. A senior economist at SMBC Nikko Securities told Reuters on May 21st, naphtha prices are increasing and trade deficits are likely to widen. Japan is experiencing this effect first. US manufacturers importing petrochemical inputs will experience it next. It arrives quietly in slightly higher prices on products that contain no oil in their name and no geopolitical signal in their packaging. The producer in Midland sees the windfall. The manufacturer in Ohio doesn't know it's paying for the same war. 4 things to watch this week. Signal 1, August 2026. That's the threshold date where independent analysts, cited by Reuters, estimate commercial inventories could reach minimum operating levels if draws continue at current rates. Watch EIA inventory data every Wednesday. Watch whether any diplomatic development, partial Hormuz resumption, ceasefire signal, US-Iran back channel, changes the trajectory before that date. Signal 2, China's pivot decision. China is still building its reserve. If Beijing reverses course and starts drawing at 1 million barrels per day, it buys the global system years of buffer. Watch Chinese refinery, throughput and fuel export policy. If the fuel export ban is lifted, China currently has fuel exports at decade lows. It signals Beijing is shifting from stock building to market participation. Signal 3, EIA, Wednesday crude export report. Watch for sustained above 5 million barrels per day. Confirmation that the record pace is structural, not a one-month anomaly. A drop back below 4.5 would signal logistics or production constraints are beginning to cap the boom. Signal 4, US retail gasoline prices. Published every Monday at EIA.gov. Watch the weekly trend relative to $4 per gallon. That's the political pressure point. High enough pump prices, and they are already high, create domestic political pressure visible enough to affect Iran policy. The export windfall and the consumer cost are building in opposite directions. At some point, they collide. There's an uncomfortable irony at the center of this story. The US imposed the maximum pressure sanctions campaign on Iran. Those sanctions contributed to the conditions that led to the Hormuz closure. The Hormuz closure created the supply shock. The supply shock created the export opportunity. The export opportunity is being captured almost entirely by American producers. Washington created the crisis. Texas is cashing the check. But the same war is building costs on the other side. At the pump, in petrochemical supply chains, in slightly higher prices on ordinary goods. The windfall is concentrated and visible. The cost is diffuse and invisible. That asymmetry, more than any single data point, is what makes this the most politically consequential energy story of the year. Full analysis in issue 5 of the Crude Oil Desk. Free newsletter every week. Subscribe at crudeoildesk.com. Hit the bell. See you next week.